stop scrolling. Because while everyone was debating whether gold hit a new record or whether the rally is sustainable, something else was happening in the background. Something that doesn't show up on price charts. Something that doesn't get discussed in market commentary. Something that reveals more about the state of the system than any technical indicator ever could. The metal is moving. Not trading hands on paper exchanges. Not shifting between ETF custodians on a spreadsheet. Actually moving, physically. Tons of it. Bars loaded into secure transport. Shipped across continents. Removed from vaults in the West, and delivered into vaults in the East. This is not a new phenomenon, but the pace is accelerating. The volume is increasing, and the reasons behind it are darker than most people want to admit. Because when gold moves at this scale, it's not because of price, it's because of trust. And when trust moves, everything else follows. Before we go any deeper, I need you to do something that takes 2 seconds, but makes a real difference. My analytics show that a huge percentage of you watch these videos all the way through, but many of you still haven't subscribed. If you value this kind of breakdown, hit subscribe right now and drop a quick comment, even just Arjan AG. So the algorithm knows this is original work worth pushing. All right, let's start with the basic question. What does it mean when gold moves physically? Because most people think of gold as a financial asset that sits on a balance sheet, a number in a vault report, a position in a portfolio. But physical gold is different. Physical gold has weight, it has location. And changing that location requires decisions, resources, and risk. You don't move hundreds of tons of gold on a whim. You move it because you've made a strategic calculation that the metal is more valuable, more secure, or more useful somewhere else. And right now, that calculation is being made at scale by central banks, by sovereign wealth funds, by nations that have historically stored reserves in the West and are now choosing to bring them home or relocate them to regional hubs in the East. This is not speculation. This is documented flow. Vault reports, shipping data, central bank disclosures, all of it points in the same direction. Gold is leaving London. Gold is leaving New York. Gold is leaving Zurich. And it's arriving in Shanghai, in Singapore, in Dubai, in Mumbai, in Hong Kong. Now, before you dismiss this as routine portfolio management, let me explain why that explanation doesn't hold. Routine portfolio management doesn't require physical relocation. If you own gold stored in London, you can sell it, trade it, or use it as collateral without ever moving it. The London vaults are among the most secure, most liquid, most trusted storage facilities in the world, or at least they were supposed to be. So if that's true, why would a central bank pay the enormous cost of physically moving hundreds of tons of gold halfway around the world? The answer is uncomfortable, because they no longer trust that the gold will remain accessible, because they've seen how quickly financial tools can be turned into weapons, because they've watched sanctions freeze assets, block transactions, and reshape the rules of the game in real time. And they've concluded that ownership without possession is not ownership, it's exposure. Now let's talk about the mechanics, because this is where the story becomes real. Moving gold is not like moving money. Money is digital, it's instant, it's weightless. But gold is physical. A standard London good delivery bar weighs about 400 troy ounces, roughly 12.5 kilograms. That's 27 pounds. One bar. Now imagine a ton. That's about 80 bars. Now imagine hundreds of tons. You're talking about thousands of bars that need to be securely packed, insured, transported, and delivered. This is not a simple wire transfer. This is logistics. This is security. This is cost. And yet, it's happening. Because the cost of moving the gold is less than the perceived risk of leaving it where it is. And that calculation tells you everything. Now, let's zoom out and look at the pattern. Because the pattern is what reveals intent. If one country repatriated gold, you could call it an isolated decision. But when multiple countries, spanning different regions, different political systems, different economic models, all start moving gold in the same direction at roughly the same time, that's not coincidence. That's coordination. Not formal coordination necessarily, but parallel thinking. Independent assessments arriving at the same conclusion. That conclusion is this: the West is no longer the safest place to store monetary reserves. Now, I want to plant a cliffhanger here because the next part is where the story gets truly frightening. If the flow of gold is accelerating, if trust in Western storage is eroding, if nations are willing to pay the cost of repatriation, what does that say about their expectations for the future? Because repatriating gold is not a short-term tactical move. It's a long-term strategic hedge. It's a preparation for a world where jurisdiction matters, where physical possession matters, where the old rules no longer apply. Let me ask you a question, and I want you to answer it in the comments. Do you think this gold flow is about diversification or about distrust? Because how you answer that question determines how seriously you take what's coming. Now, let's talk about the specific regions where gold is landing, because the destinations are not random. China has been the most aggressive accumulator, not just through central bank purchases, but through infrastructure that facilitates gold storage, refining, and trading. The Shanghai Gold Exchange is now one of the largest physical gold markets in the world, and the flow of metal into China has been relentless. Some of it comes through official channels, some of it comes through unofficial channels, but it all moves in one direction. India is another major destination. Cultural affinity for gold is part of the story, but so is strategic thinking. India has been quietly building reserves, encouraging domestic refining capacity, and reducing dependence on Western supply chains. The Middle East is also absorbing gold. Dubai has become a regional hub, a place where metal can be stored, traded, and moved with fewer geopolitical constraints than London or New York. And Southeast Asia, particularly Singapore, has positioned itself as a neutral storage center, a place where capital from both East and West can feel secure. What all of these destinations have in common is sovereignty. They are jurisdictions that nations believe they can control, or at least trust not to freeze their assets on political grounds. And that's the key. This is not about yield. This is not about returns. This is about control, about making sure that when the system is tested, when pressure is applied, the gold is in a place where it can't be leveraged against you. Now, here's where the narrative gets darker. Because the flow of gold out of the West is not just about repatriation. It's also about speculation that the West may not have as much physical gold as it claims. Now, I'm going to be very careful here, because this territory quickly becomes conspiratorial. But there are legitimate questions that have never been satisfactorily answered. Questions about audits. Questions about whether gold held in custody is unencumbered, or whether it's been leased, swapped, or hypothecated multiple times. Questions about whether the gold that shows up on vault reports is actually sitting in the vault, or just a claim on gold that may be sitting somewhere else. These questions persist because transparency is limited. Most major vaults do not allow independent audits. Most central banks do not publish detailed bar lists. And when questions are raised, the responses are often vague, dismissive, or legalistic. Now, that doesn't prove wrongdoing, but it does create doubt, and doubt is enough to drive behavior. If you're a central bank and you have even a 5% suspicion that your gold might not be fully accessible, you're going to demand physical delivery. And if you demand delivery and it takes months longer than expected, or if excuses are made about logistics or scheduling, that suspicion grows. And once that suspicion spreads, the flow becomes unstoppable. Because no one wants to be the last central bank demanding their gold only to find out there is not enough to go around. Now let me introduce another layer that most people completely miss. The flow of gold is not just a monetary story, it's a geopolitical story. Because gold is the ultimate neutral reserve asset. It's not denominated in dollars. It's not dependent on any single nation's credibility. It's universally recognized. And in a world where currency wars, trade wars, and sanctions are becoming normalized, gold is the asset that can't be frozen, can't be canceled, and can't be devalued by decree. So when nations move gold, they're not just moving metal. They're moving monetary sovereignty. They're building parallel infrastructure. They're reducing dependence on the dollar system. And they're preparing for a world where the old order is no longer guaranteed. Now, let's connect this to what's happening in other markets, because nothing exists in isolation. At the same time gold is flowing east, we're seeing other signals of stress. Bond auctions showing weak demand, currency volatility increasing, trade settlement shifting away from dollars, swap lines being activated. All of these are symptoms of the same disease, trust erosion. When trust in the system erodes, capital seeks safety. And for thousands of years, safety has meant gold. Not because gold pays a dividend, not because gold has industrial utility, but because gold is the asset that survives regime change, currency collapse, and system failure. Now, I need to address something that always comes up in the comments. People say, but John A.G., if gold is moving east, doesn't that just mean the East is buying and the West is selling? And the answer is more complicated. Yes, there is buying happening. Central banks in the East are adding to reserves. But the flow is not just about new purchases. It's about relocation of existing holdings. It's about gold that was stored in London for decades suddenly being shipped to Shanghai. It's about gold that was held in New York being moved to Singapore. That's not buying. That's distrust. And that distrust is the story. Now, let's talk about the pace, because the pace is what makes this urgent. For years, gold flows were steady but slow. Repatriation happened, but it was gradual. Measured. But recently, the pace has picked up. More tonnage, more destinations, more urgency. And when urgency enters the picture, it's usually because the window is perceived to be closing. Because the people making these decisions believe that at some point in the near future, moving gold may become more difficult, more expensive, or impossible. And if that's their calculation, you have to ask yourself, what do they see coming that would make moving gold impossible? The answers are all unpleasant. Capital controls, asset freezes, sanctions, emergency measures, war. Any of those scenarios would make physical relocation of reserves nearly impossible. So the smart move is to act before the window closes. And that's exactly what's happening. Now, I want to bring in a practical dimension because this is not just about nation states. This flow has implications for individual investors too. When gold moves east, it tightens Western supply. It reduces the available float. It makes physical delivery more difficult in Western markets. And when physical delivery becomes difficult, premiums rise, wait times extend, and the disconnect between paper price and physical reality widens. We've already seen glimpses of this. During moments of high demand, premiums on physical gold in Western markets have spiked. Delivery times from major mints and refiners have stretched from weeks to months, and some products have simply disappeared from availability. Now imagine that situation not as a temporary squeeze, but as a structural condition, where gold is persistently leaving the West and not returning, where supply to retail investors and smaller institutions becomes permanently constrained. That's when the paper price and the physical price become two different markets. Now, let me plant another cliffhanger, because the next section is where this gets even more intense. If the flow continues, if Western vaults continue to drain, at some point the system faces a choice. Either acknowledge the reality and let premiums rise to reflect true scarcity, or intervene to suppress price and maintain the illusion of abundance. And history tells us which choice gets made: suppression, control, management, until the moment control breaks and the price explodes. Now, before we go deeper, I need to mention something practical for those of you who want faster updates and more direct commentary. I've set up a WhatsApp channel where I share daily posts, quick voice notes, and instant alerts when something important hits the tape. The link is in the description. Join it, because these moments don't wait for upload schedules. All right, let's talk about the infrastructure that's being built in the East, because infrastructure reveals intent. China has not just been accumulating gold, they've been building refining capacity, they've been developing vaulting facilities, they've been creating trading platforms, they've been establishing quality standards and certification processes. All of this takes years. All of this requires investment. And all of it signals that China is preparing to be a center of physical gold trade in a way that rivals or surpasses London. Why does that matter? Because the location of infrastructure determines the location of power. For decades, London has been the heart of the global gold market. The London Bullion Market Association sets standards. London vaults hold the majority of above-ground investment gold. London is where price is discovered. But if the metal moves, if the vaults in London empty, if the refining and trading activity shifts east, then power shifts with it. And that shift is not just about gold. It's about monetary influence, about who controls the mechanisms of value, storage, and exchange. Now, let's talk about what this means for the dollar, because the dollar and gold have always been in tension. The dollar is a promise backed by trust in the US government. Gold is an asset backed by nothing except scarcity and history. When confidence in the dollar is high, gold is boring. When confidence in the dollar weakens, gold becomes essential. And right now, the flow of gold suggests confidence is weakening. Not collapsing, not yet, but weakening. And the nations moving gold are the ones who see the cracks most clearly. They see the debt load. They see the deficit spending. They see the political dysfunction. They see the willingness to use financial infrastructure as a weapon. And they see the risk that the dollar, while still dominant, may not remain so indefinitely. So they hedge. And hedging means gold. And gold means possession. And possession means moving the metal now, before conditions change. Now, I want to address the skeptics, because I know some of you are thinking, this sounds dramatic, but isn't gold always moving around? Isn't this just normal market activity? And yes, gold does move, but not at this scale, not in this direction, not with this persistence. When you see consistent one-directional flow over multiple years, when you see the pace accelerating, and when you see infrastructure being built to accommodate the flow, that's not normal market activity. That's structural repositioning. And structural repositioning is what happens before the rules change. Now, let's talk about the European angle, because Europe is caught in the middle of this flow. Some European nations have been repatriating gold from New York and London. Germany famously brought gold home. Austria followed. Netherlands followed. These are NATO allies. These are trusted partners in the Western Alliance. And yet, they decided physical possession was worth the cost and complexity of repatriation. Why? Because even within the alliance, trust is not absolute. Because sovereignty matters. Because in a crisis, the nation that holds the gold has options. The nation that trusts someone else to hold it is vulnerable. Now, here's where the story becomes a mirror. Because the same logic that drives European repatriation drives Eastern accumulation. It's the same calculation, the same fear, the same understanding that in a world of increasing uncertainty, physical possession is the only true security. And if that's the calculation being made by sophisticated, well-informed, strategically minded institutions, what should that tell individual investors? It should tell them that the rules they've relied on, the assumptions they've built portfolios around, may not hold. that paper claims may not be as solid as they appear, that accessibility may not be guaranteed, and that the time to position is before the crowd realizes it. Now, let's talk about timing, because everyone always asks, when does this matter? And the honest answer is, it already matters. It's mattering right now. The flow is happening, the vaults are draining, the infrastructure is shifting, but the price signal hasn't fully reflected it yet. And that disconnect is the opportunity. Because when the price catches up to the reality, when the market reprices to reflect the new geography of gold, the adjustment will not be gentle, it will be violent. And the people positioned early will capture that move. The people who wait for confirmation will pay the premium. Now, I need to introduce another cliffhanger, because the final act is where this all comes together. If the flow continues, if the West loses its position as the center of the physical gold market, if the East becomes the new hub, the entire monetary system gets reordered. The dollar's role as reserve currency weakens. The ability to use sanctions as a tool diminishes. The power dynamics that have defined global finance for 70 years get rewritten. And that rewriting doesn't happen peacefully. It happens through crisis, through stress, through moments where the old system breaks and the new system emerges from the chaos. Now, before we move into the final section, I need to mention the members-only video. By the time you're watching this, there should already be a members-only update published with deeper analysis and the latest developments bundled in one place. If you want that level of detail, join the membership and check it out. It also shows me who's truly following the work closely. All right, final act. Let's talk about what this means for you personally, because understanding the problem without having a response leaves you stuck. If gold is flowing east, if trust in Western storage is eroding, if the monetary system is being quietly reordered, the strategic move is to align with the flow, not against it. What does that mean practically? It means questioning the assumption that paper gold is equivalent to physical gold. It means questioning the assumption that storage location doesn't matter. It means questioning the assumption that the system will function the way it always has. And it means making decisions based on those questions. If you own gold, do you own it physically or through a claim? If you own it through a claim, do you know where it's stored? Do you know if it's allocated or unallocated? Do you know if you can demand delivery? These are not paranoid questions. These are prudent questions. And the answers determine whether your gold position is an asset or an exposure. Now, let me give you a framework for thinking through this. Physical gold that you possess is an asset. Physical gold stored in a secure facility where you have allocated ownership and can demand delivery is an asset with a small counterparty risk. Physical gold stored in a pooled account where you don't have specific bar numbers is a claim with moderate counterparty risk. Paper gold, ETFs, futures, certificates is a claim with high counterparty risk. And the further you are from physical possession, the more vulnerable you are to system stress. So the question is not whether gold is valuable. The question is whether you'll be able to access it when you need it. Now, I want to address one more dimension that ties everything together. The flow of gold is not just about central banks and sovereign wealth funds. It's also creating opportunities and risks for private investors. The opportunity is that if you're positioned early in physical gold, you're ahead of a repricing. The risk is that if you're positioned late or in the wrong structure, you may discover too late that your claim isn't as solid as you believed. This is why I keep emphasizing awareness. Awareness of flows, awareness of vault data, awareness of premiums, awareness of delivery times. These are the signals that reveal system stress before the price does. Now, let me ask you a final set of questions, and I want you to answer them in the comments. First, do you think the flow of gold east is temporary or structural? Second, do you think Western vaults still hold all the gold they claim to hold? Third, if you own gold, do you own it physically or through a claim? Your answers tell me where the community is leaning, and they also tell me what to cover next. Now, I want to bring this full circle because we started with a simple observation. Gold is moving, physically, from west to east. And that movement is accelerating. And the reasons behind it are not about price, they're about trust. Trust in jurisdiction, trust in accessibility, trust in the system's stability. And when trust erodes, when nations and institutions decide possession is more important than convenience, it's a signal that the old assumptions are breaking down, that the old order is being questioned, that the new order is being built quietly, one bar at a time. So here's my final takeaway. The flow of gold is not just a financial story, it's a story about power, about sovereignty, about preparation for a world where the rules we've taken for granted may no longer apply. And the people moving the gold understand that. The question is, when will you? Subscribe if you haven't, join the WhatsApp channel in the description for daily updates, and drop a comment, even just RJohnAG, to support the algorithm push. And here's my final question. If gold is leaving the West, what does that tell you about the future of the West? Think about it, and I'll see you in the next one.